Hello and welcome back to our channel Polo Vega. Today we're going to talk about the importance of time frames or the charts that we're looking at or the size of the charts that we're looking at. The whole idea is to filter down from a bigger picture into a smaller picture into the smallest time frame where we intend to place our trade. The time frames usually are divided into three categories. The first one being the HT or the higher time frame or the biggest or the big picture. Then we go to the IT or the intermediate time frame, and then finally to the lower time frame where we intend to put our trades. But we can also dive down into a smaller time frame where we can analyze the entry level before we place our trade. Before we move on to our video, let's look at the disclaimer/disclosure clause. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 20th of a series of interactive videos aimed at educating our viewers about the basics of trading and investment. Once we've been through the preparation for the day, we've studied the environment, and we know the parameters that could affect the trade during the day. Then we need to go about setting up the workspace, which involves the study of different time frames that are going to come into action during the movement of price from our entry to the exit level. In order to get an idea about the ongoing action in the environment in which we wish to place an order, we must divide the workspace into three different frames, each being 1/4 of the time frame above it. We may not stick to the exact multiplier, however, the time frame must be divided into three different parts, giving us the big picture, the intermediate time frame, and the lower time frame where the action is taking place. That is where we enter the trade, and the trade is intended to move in the direction that we think, and the location of the exit. For example, if we wish to place the trade on a 15 minutes chart, then we must look at the 60 minutes and the 240 minutes chart as well. The 240 minutes chart gives us the broader or the bigger picture where we see the beginning and the end of the trade or the trend historically. Then we look at the intermediate time frame where we see the present trend, and if there are any obstructions or buyers or seller areas. Since we've already spoken about different time frames or the pictures that play a very important role of the movement of price from our entry area to the intended target area, we must follow these charts very strictly. The first being the HT or the high trade time frame. As shown in the adjacent chart, we'll first look at the highest time frame to get an idea of the big picture with areas where the trend had started and the area where the trend could come to an end. We then move on to the IT or the intermediate time frame, which in our case happens to be the 60 minutes time frame, and the trend here is sideways. Now, most of us, we try to avoid sideways trends because of the uncertainty of the movement of price, because the price could either break out above the supply zone on top or could break down below the demand zone at the bottom and could go against us any moment, and we could lose the small profit that we were trying to obtain. Therefore, it's better to wait for the price and to either form a higher low, which happens to be an upward movement or an uptrend, and it could be a lower high which could form a lower or a downtrend, and we could then take a seller's trade. We then finally look at the lower time frame where we decide on our points of entry and exit. In the adjacent chart, we are in an area where we should wait for the price to reach our zone, which could be either the seller's area or the buyer's area. Since the price is in a no man's land, we should not take a trade at this point. After having talked about the different time frames, we should then look at scanning the environment before setting up a trade. Although we look at three distinct time frames, which happen to be our working time frames, when we decide to place a trade, we must be aware of the general environment before we choose an area and direction of trade. Therefore, we look at the monthly, the weekly, and the daily charts before we decide to trade any time frame. The yearly time frame is too large a time frame unless we're looking at trading on the weekly or monthly time chart. For day trades or swing trades, we basically look at the hourly time frames as our HT, IT, and LT time frames. But we need to bear the direction of price and location of buyers and sellers areas on the daily and the weekly charts in our minds so that we can follow our directions and areas as far as practicable. Once we've done the analysis of the environment and we've jotted down the role of different time frames with regards to our trade that we wish to take, we must also look at the higher time frame zones which could affect the journey of our price from our entry to the exit point. A seller's or a buyer's area along with the direction on a higher time frame always supersedes those on a lower time frame. As seen in the chart alongside, a buyer's area on the 15 minutes chart has got superseded by a seller's area on the 240 minutes chart. Therefore, before we enter a trade, we must carefully look at all the trends and all the buyer's areas and the seller's areas on different time frames that could hinder, obstruct, or completely destroy our trade. As traders, we always try to follow the direction of price in a particular direction, which is known as trend. There's also another term called the momentum, which is the strength of the movement of price in a particular direction. But there's a third word which cannot be ignored by anyone, and that's curve. Curve is basically the beginning or the end of a trend. Although trend plays a very important role in the movement of trade in the desired direction, one must not ignore curve while following a trend. Curve is a buyer's area at the beginning of an earlier trend or a seller's area at the end of the previous trend or vice versa. In either direction, it's best to come out of a trade when heading into a curve while following the trend. A strong trend may just allow price to blast through a curve area, but more often than not, there is always a reversal attempt when price arrives at a curve. So it's best to wait out for price to establish its new direction by going past a curve or reversing from a curve. In either case, one must follow the rule of 2 higher lows on a lower time frame for an uptrend and 2 lower highs for a downtrend on a lower time frame. To summarize what we spoke about today, we should always keep the big picture in mind and respect zones on higher time frames. Always avoid counter trend trades as they may give us profits during the corrective moves, but if we manage to gain early on a trend, then the rise can definitely give us substantial profits. If you liked our video, please give us a thumbs up, press the button underneath to subscribe to our channel Paulo Veiga and watch all our videos. You may also visit us at our website www.pauloveiga.com or get in touch with us through our Twitter handle @PauloVeiga. Please keep saving, keep investing, and keep getting wealthier until we meet next. We thank you for watching our video. Please like, share, and subscribe to our channel Paulo Veiga. Bigger picture is always the better picture.